So in the last video, we put Euro USD and GBP USD side by side and found two completely different personalities hiding behind two very similar looking charts, the calm, patient teacher and the fast, temperamental athlete. But those two pairs also had something in common that we never stopped to question. The dollar was sitting on the right side of the price. Today, that flips. And when it flips, something much bigger flips with it. Because the two pairs we're about to meet don't just react to economics, they react to fear. These are USD JPY and USD CHF, the market's so-called safe havens. When the world gets nervous, money doesn't vanish. It runs somewhere it trusts, and an enormous amount of it runs straight into the Japanese yen and the Swiss franc. So by the end of this video, you'll know what a safe haven really is, what drives each of these pairs day to day, why one is a story about interest rates, while the other is a story about fear, and what changes now that the dollar is standing on the left. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. So let's start with what these two pairs actually are, because there's a detail hiding in them that changes how you read the chart. USD JPY is the US dollar measured against the Japanese yen. USD CHF is that same dollar measured against the Swiss franc. Notice what just happened. In Euro USD and GBP USD, the dollar sat on the right. Here, it's on the left. And remember our base and quote lesson? The currency on the left is the one being priced. So on these two pairs, you're not pricing something in dollars anymore. You're pricing the dollar itself. And that flip hands you a reading rule you can use immediately. When USD JPY goes up, that is not the yen getting stronger. It's the dollar getting stronger against the yen. When it falls, the yen is winning. Same on USD CHF. Up means dollar strength, down means franc strength. Lock that sentence in, because a big share of the confusion beginners have on these pairs comes from reading them backwards. Now, the label you'll hear attached to both the yen and the franc is safe haven. It sounds mysterious, but the idea behind it is very human. When the world turns scary, a war headline, a banking scare, a crash in stocks, money doesn't disappear, it moves. And in those moments, big money stops asking, where do I earn the most? And starts asking, where do I not lose it? A safe haven is simply where that money goes to sit and wait out the storm. So why the yen? Japan has spent decades as one of the world's great creditor nations. Japanese investors, funds, and companies hold an enormous pile of assets parked outside the country. When fear hits, a lot of that money comes home, and coming home means selling foreign currency and buying yen. On top of that, the yen is one of the most traded currencies on Earth, sitting on one side of roughly 17% of all Forex turnover. It's deep enough to absorb that rush without breaking. The franc earned its reputation a different way. Switzerland is small, but famously stable. Politically neutral for centuries, with a long history of low inflation, solid institutions, and a financial system built around one promise: keeping money safe. So the franc isn't a haven because Switzerland is powerful. It's a haven because Switzerland is boring, in the best possible sense of the word. Think of the yen as money coming home, and the franc as money going into the vault. That gives us the two moods that drive these pairs, and you'll hear them named constantly in this business: risk on and risk off. Risk on is when the world feels confident. Money leaves the safe corner and goes hunting for growth and higher returns. Risk off is the mirror image. Confidence cracks and money sprints back to the corner it trusts. Really, it's just two weather settings for the entire market, and the havens are the shelter. So what does that look like on your chart? In a real risk-off wave, the yen and the franc tend to strengthen, and since both of them sit on the right side of these pairs, strengthening havens usually push USD JPY and USD CHF down. Risk-on tends to do the opposite. Money leaves the shelter, the havens soften, and the pairs drift up. So if stock indices are bleeding and the headlines are ugly, assume the havens are being bought. But let me be honest with you, because this is exactly where the textbook cracks. The US dollar is a safe haven too, arguably the biggest one on the planet. So in a truly global panic, USD JPY isn't fear against calm. It's two safe havens pulling on opposite ends of the same rope, and which one wins depends on the kind of crisis it is. When the trouble is centered on the United States, the yen usually wins. When the trouble is global and everybody just wants dollars, the dollar can win instead. That's why risk off means USD JPY falls is a guideline, never a law. Alright, fear explains the dramatic days. But most days aren't dramatic, so let's talk about what moves USD JPY the rest of the time. And it comes down to the price of money. Interest rates. Every currency effectively pays you a rate to hold it, and money, being money, drifts toward wherever it gets paid more. The difference between two countries' rates is called the interest rate differential, and on USD JPY, that differential is the main engine. And this is where Japan is genuinely unusual. For decades, Japan has run some of the lowest interest rates in the world, at times essentially zero, and even below zero. Meanwhile, the United States has usually paid noticeably more, so holding dollars paid you something, and holding yen paid you almost nothing. And that gap pulled money out of the yen and into the dollar year after year. That steady pull is a huge part of why USD JPY has spent such long stretches grinding higher. So the practical version is this. On USD JPY, you're really watching two central banks, the Federal Reserve and the Bank of Japan, and specifically the gap between them. When that gap widens, the pair tends to climb. When it narrows, or when the market merely starts to expect it to narrow, the pair tends to fall, and it rarely falls politely. That's exactly why this pair has come back to life as Japan slowly moves away from its ultra-low settings. Which brings us to USD JPY's personality, and it's a strange one. This pair can trend beautifully. Long, patient, orderly runs that go on for weeks while the interest rate story stays stable. And then it can turn on a dime. When fear arrives or when the Bank of Japan surprises anybody, USD JPY can hand back weeks of movement in a single session. So think of it as calm and cooperative, right up until the moment it isn't. Now the franc, and I'll be straight with you here. USD CHF is the quiet one of the group. It's a genuine major, it's liquid, and its spread is tight, but the franc simply doesn't generate the volume or the headlines the yen does. So most of the time, USD CHF isn't really telling you a story about Switzerland at all. It's telling you a story about the dollar, with a little fear mixed in. There is one thing about the franc you absolutely should know though, because it's a fantastic lesson. Switzerland is an export economy, so an overly strong franc actually hurts it, and the Swiss National Bank has a history of stepping in to stop that. Back in 2011, it capped the franc against the euro, and in January of 2015, it removed that cap with no warning at all. The franc exploded, moving in minutes more than it normally moves in a year. Nobody is predicting that repeats, but it's a permanent reminder that here, a central bank is a participant, not a spectator. One more practical thing about USD CHF, and it matters more than people expect. Because the dollar sits on one side and a European currency sits on the other, USD CHF tends to move almost like a mirror image of Euro USD. When Euro USD rises, USD CHF very often falls. So if you buy Euro USD and sell USD CHF, thinking you've placed two separate trades, you haven't. You've placed the same bet twice, with double the risk. We'll take that apart properly in the chapter on correlation, but plant the flag now. So should a beginner touch these pairs at all? Here's my honest take. USD JPY is a perfectly reasonable second pair after Euro USD. It's deep, it's cheap to trade, and it trends in a way that rewards patience. Just respect the fact that its reversals are violent. USD CHF is fine as well, but it's slower. And if you're already trading Euro USD, it's often just the same story told backwards. There's not much point in watching a mirror. And let me draw the line on this video the same way I always do. Understanding what moves a pair is not the same as knowing when to enter it. Where you draw your levels and how you time a trade lives inside our technical analysis course. And the part of you that panics when the world panics, the part that decides whether you hold or fold on a risk-off day, that belongs to our trading psychology course. Here, we're just making sure you know what you're looking at. So here's something practical you can do the second this video ends. Pull up USD JPY and USD CHF side by side and put Euro USD right next to them. Watch how USD CHF and Euro USD move like reflections of one another. Then go find a day in the recent past when stock markets fell hard and look at what USD JPY did on that day. You'll see risk off with your own eyes, and that will teach you far more than any definition I could give you. So let's bring it home and answer the question we started with. What makes USD JPY and USD CHF move? Two forces, the price of money and the mood of the world. USD JPY is mostly a story about interest rates, the Fed against the Bank of Japan, with fear stepping in to create the violent turns. USD CHF is mostly a story about the dollar and about safety, watched over by a central bank that has proven it will act. Learn to read those two forces, and neither pair feels random anymore. So that's 4 of our 7 majors met. The calm one, the fast one, and now the 2 shelters. In the next video, we go somewhere completely different. The commodity dollars. The Canadian dollar, the Aussie, and the Kiwi. Currencies tied to oil, to metals, to China, and to the price of things you can actually hold in your hand. Why does the loonie care so much about a barrel of oil? That's next. I'll see you there, trader. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader Community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.